Get the last sip in. All right, how you doing, folks? Wake up. It's August 1st, and the markets are already on fire. Trump's tariff tantrum. I got to say that. I was just thinking about saying that like 10 times fast. Trump's tariff tantrum. That I can't even say it 2 times fast. Just nuked global markets overnight. The VIX is popping at 18.77 currently, I believe. Yep. And man, yesterday we were teetering with getting below 15. Like it's 2022 all over again. And we've got the mother of all job reports dropping in about 9 minutes. The The SPX kissed its all-time high yesterday, only to get slapped back hard. Is this a rejection that breaks the bull, or just another fake out before we rock it? You got to stick around as we decode chaos, spot the convex edges, and arm you with trades that thrive in this mess. That's because what we do here is tail risk trading, asymmetric positions. We're never taking big risks, but we're always after those big convex asymmetric moves. So that means that we don't lose money, we make a lot of money. So let's take a little reflection first. Let's ask ourselves, are we chasing fear or positioning for asymmetry? I know what I'm doing. I guess I'm asking, what are you doing? So before we get too deep into it, no, I'm not going to go to the charts yet. The sweet smell of market tension in the morning. It is nothing like a presidential tariff blitz to remind us that the geopolitics can trump data any day. Yesterday, the SPX teased us with that shiny new high around 64.27, but bam! Rejected like a bad date. Closing down at 63.39 with futures bleeding another 100 points overnight. And the VIX, that was snoozing just above 15 yesterday in zombie land. Now it's wide awake at 18.77. Is that where we're at right now? Let me just check here. Correction. It's relieved a little bit. Now it's at 18.6. But it's squarely in Goldilocks land. Why do we call higher VIX something sounding prettier and nicer than Zombieland when it's low, where everybody else thinks it is? That's because when VIX is low, the risk is much higher for normal traders. For options traders, we love that high volatility. So as it gets higher and higher between, say, 17 and 32, we actually consider that Goldilocks, just right, perfect. All right. Anyways, now that we're up into an area where we love to play, it's kind of whispering vol warp ahead. All right, and here comes the non-farm payrolls, and now in about 6 minutes, there's 106,000 jobs expected, unemployment ticking at 4.2%. If it misses, watch yields crater and equities dive into that volume well below 63.20. Yeah, we'll see these on the charts in just a sec. But the real story really is Trump's dropping 25% on India, 20% on Taiwan, and even sparing Mexico for 90 days. And also, I believe, a 35% tariff on Canada. So supply chains are screaming, tech is taking the hit, and emerging markets are in full retreat. This ain't prediction theater here. It's convexity hunting. A lot of people ask me, what is convexity, Ernie? Convexity is that point where option prices start diminishing because most options buyers, sellers are no longer interested. And so the rate of change in an options price is changing at a faster rate. That is the convexity. That is, so if you think of a mirror, a convex mirror, it kind of goes like this. No matter which way the light hits, it focuses on a point. You can kind of think of our trading that way. When we hit that convexity part, no matter which way light hits, we're either good or not bad. In other words, it's all focusing on good stuff for us as traders. So what we're going to do as the VIX is going up, we're starting to think, hey, let's start playing both sides of the market. We can afford to do that. We can play further out of the money. We can expect a higher expected move, although expected move doesn't really factor into our trading here because we're looking for those moves that exceed. And today is like one of those days. So we'll start talking about volatility popping. We'll look at sigma drifting on a data surprise. And as always, we're going to hold that mirror up and ask, what's the bias blinding you today? You know, I mean, were you prepared for such a move? Now, I know that in the beginning of the week, I had originally said, it looks like we're going to get like a 2 to 3% move down. And then, of course, the Fed came into that picture, and then people got some kind of reprise and thought that maybe things aren't so bad. And then, of course, Trump laid down the tariff rule. So if we have any kind of miss on employment, then I think you're going to see that 2 to 3% prognostication come true. So let me ask you, for you, is it FOMO on this dip or fear of the fat tail? So let's reflect. Always act small and harvest that asymmetry by positioning your trades, not predicting. Now, just because I said I thought that the markets might come down, that doesn't mean that I am predicting, because I really don't know. And it sure looked like on Wednesday that we were going the other way, and then everything yesterday, at least in the beginning of the day, looked like, we're going up instead of down as I had predicted or assumed because of the situation. And then, bam, it all turns around. Trump says a few words, and the market is in a completely different loop. All right? So that's it, Earthlings. Thank you very much. This is Ernie, Coach Ernie, or Dude from Earth. Let's go to the... you gotta find the button. The charts. There we go. All right, so VIX is at 18.56. You can see way over here to the right, it's like this little mini spike. Bam! We went way up. I don't know. Let's see what it looks like on... Here's crude oil. That's crude oil. Let's look at... Oh, I don't know what I'm looking at. VXN. That would be the NASDAQ, right? Okay, yeah. See, big spike right there. Let's look at the S&P VIX. Oh, yeah, there we go. So NASDAQ didn't really feel a big brunt, but here's the VIX this morning. Whammo. So what does that mean for us as zero DTE traders? That means that now we're going wider, much wider. Before we were at 20 to 35, and I was considering even 15 wide butterflies. Now we're talking 40 to 30 wide. And I was going to talk about time warp trades as we were seeping down here. And in fact, I will still talk about it in my my school community this morning. We have a coach call on Fridays, Mondays and Fridays. So we will talk about time warp trades, and that's when volatility starts dropping so much that premium decay is increasing, and instead of a 0 DTE trade, we start thinking about 1 to 2 DTE trades because of the accelerated premium decay. So we'll be talking about that this morning. I mean, that's what I planned on talking. I didn't plan on the market taking a big turn. So that's the way it goes. All right, so getting back to, we are looking at classic out-of-the-money butterflies today. We have a directional bias of down. As you can see here, we are definitely, let me just change that right here. Directional bias is bearish, so I got to change that. I feel like a yo-yo in the last few days. All right. Yeah, the golden cross doesn't mean crap. But there's the directional. That should be bigger, right? let's make that 40. There we go. Now it stands out. All right, directional bias is down. So we know how wide we are. We know what direction we're going. We're looking at put flies. And let's look at the market structure now. So we need to back up on this market structure a bit and see where we are. Wow, I can't believe it came all the way down here. So let's go back to this chart. I have it nice and colorized. So we're going to back out to about an hour chart, and then we'll make, okay. Can you see that volume profile okay? I think I need to brighten it up a bit. Let's brighten it up just a little bit. There we go. That's beautiful. All right. And wow, it's getting really messy over here, but you can see prices at 63.08, and that's, man, 150 points lower than we were yesterday. You see this very large node here that is outlined by the green and red lines here. We're sitting here at what, 63.06 now? We're dropping as we speak. We're right there. So we're right near the top of this node. Let's see. Let me just get rid of all the lines for the time being. So you can see that we're right here at the top of this node. There's not a whole lot of space here in terms of low liquidity, but this little crevice here, that's going to present some significant resistance for us to recover and come back up, at least for now. So I think we're going to be playing in this node for a little while and revisiting this channel that we developed before we broke out way back in mid-July. Right, so here was the big breakout right about, actually it was right about July 22nd. So it wasn't really mid-July, it was the last week of July we broke out. But we had this channel going on for quite some time since the beginning of July, and then we broke out to new highs. I guess you could say we created a double top here. Is that what that is? Some people are going to say that. I don't really pay attention to that too much, but that's, you know, that's the facts. We hit highs you know, a few consecutive days within a week, and then got soundly rejected. And we didn't get rejected because of the double top. We got rejected because of the situation. And the situation says tariffs. And tariffs are looming. Now, of course, if this doesn't give Jerome Powell his, quote, data to lower rates, I don't know what will. You know, so let's see what happens as September rolls along. Well, let's see what happens for the rest of August. We still got August to get through, but September is the next rate cut meeting. But yeah, I think that we're playing in here. It looks like we're going to exercise this same channel again. I mean, it's pretty big, and this node is pretty big. So we have support right here at about 62.62. Which is about 30. So this whole node here is about 40 points, 45 points in height. This is where I expect that we're going to spend some time trying to figure out where we're going to do. If things kind of break down, then there is, let's bring more of this in here. There is a much larger volume well. Let's see if we can bring it in here, right here. All right. Now, this volume well here is a slippery slope. So really, what we're really looking at is a bottom of 62.34 and a top of, let's call it 63.20. So about 100 points. That's where we're playing right now. If we break down below this, we could have a substantial move down. But this is going to be super strong support right here at 62.30. 62.30 and right here 63.20. So about 90 points. All right, right there. There's our playground for the next, I think for the month, that we're going to be battling here to see whether or not we go down further or we try to go back to all-time highs. I suspect that with Trump administering this new medicine to the world, that there's going to be a lot of consternation over that. August is typically an okay month in terms of returns, but we're putting pressure now on the market. When we hit September, September is one of the worst months for returns historically. So I'm thinking that this is kind of all setting up for something dramatic, and that in September and October is not too much better than September. That we could be setting up for a big drop coming in the early fall. All imaginary in my point of view, really just based on this tariff scare, and particularly if Jerome Powell is stubborn and doesn't lower rates in September or give us at least some reprieve, that would just add on to it. That would just make traders apoplectic. So I think that this makes big plays for us options traders. This is where convexity really lives. I'm going to be playing very large positions, but with super small risk in this area here, anticipating that at any point we could drop down there. Those are going to be big payoffs. This is sort of medium-term trades. We call these sigma drift trades. Typically, let's say 5 to 10 days DTE, and so we'll overlap those, and we'll play both sides, because we could get a move up. I suspect that these put flies are going to be much more expensive, so they're going to be a little bit further out of the money, and the call flies are going to start getting cheap. So we'll add both of those on into the mix. All right. So there you go. And then for portfolio insurance in particular, we'll start looking at puts here. All right. All right. Let's get back to the big head. There we go. That's about it. That's my prognostications. We are very grateful that volatility is up, because, quite frankly, going down into that zombie land, it's exactly what it feels like. Zombie land feels like you're being chased by zombies and you're running through mud. From an options trader's point of view, when volatility gets up here, everybody gets a spark of life, and we're thinking, yeah, everything's great again. And that's what we're hoping. We need volatility in order to survive and make money. I mean, we make money in zombie land too, but it's just sort of a trudge. And so I'm excited. I don't know if you can feel it. I am totally excited when we get volatility spiking like this. Let's hope that we get some more great news. Have we already got the jobs report come through? It doesn't look like there has been much of a change in the market here. Because I talked right through it, right? Let me go back to a short term, and let's see, at 8:30. So what happened at 8:30? Yeah, so we had the market dropped and then recovered very quickly. So I'm going to assume that the jobs report was probably not as good as expected. I haven't looked at it yet, so I'm just looking at the price action here. Might as well. Let's take a look at that. All right, so here's the market. So that big red bar is 8:30. And let's take a look at the jobs report. Let's see if we can bring it into view here. Oh wow, big miss on non-farm employment change. We were expecting 106K, but only got 73K. The unemployment rate, however, is staying at 4.2%. So that's interesting. So that must mean, let's see, and the average hourly wage has stayed steady, which is a little bit better than last month. So last month it was 0.2%. This month it's 0.3% increase. So non-farm payrolls are definitely not a good thing. I think that, along with tariffs, I think if this, like I said, if this doesn't give Jerome Powell the impetus to lower rates, I don't know what will. Then you just know that it's a personal vendetta between him and the Fed governors. So there's no other reason for that. We still at 10 a.m. have ISM manufacturing coming up, and that is a very impactful report. So we'll wait to see what that produces, whether or not that will pigpile onto all of this. But the unemployment situation is that is going to require further analysis, because the top line numbers are the top line numbers. We still have to look at the participation rate and other things. We'll have to look at the government numbers versus the household numbers, which are often at odds. At least they have been for the last few years. So it's tough to evaluate this. But so far, if I look at just price alone, what I'm seeing here is that the first glance was, oh, bad employment report. And then all of a sudden the market is absorbing that and going straight up. You got to wonder, what are they looking at? Are they looking at the same thing I am? I think what's happening is, like I said, you have to look at the whole report and then digest it. It's kind of like looking at the EAI report for petroleum reserves. Everyone looks at the top line number and thinks that, either the market's going up or down based on the amount of reserves that are available, or what was expected and what the delta was. But here, it's the same thing with the employment report. It's really the underlying factors, as it is with energy, that's really going on. And I suspect that there are some positive numbers underneath, or maybe the market initially felt the shock. Here, I'll go back to the big head. So the market initially felt the shock of a disappointing jobs number, but then thought, oh, but wait, that's disappointing, but it could be good, because then Jerome Powell might finally release his grip on rates and decide to cut them. And maybe even instead of a quarter point, 25 basis point, he might go to 50 basis points. And so then the market gets all excited, and so they rally thinking that they're going to see cheaper money in September. Seriously, that's the way they think. It's like opposite world. Bad news means good market. But these days, for whatever reason, the Fed chair and the rest of the governors are using tariffs as a way to say, we don't know what the hell's going on, so therefore we're not going to do anything. That's their excuse. All right, I am just rambling on, and I could rant about this much more, but I'm trying to restrain myself, as you can tell. In any event, it's Friday. And so that means that we have a nice weekend ahead of us. It's still summertime, right in the middle of summertime. So we got to enjoy that. Anyways, this is Coach Ernie, and I am out. Take care.